All right. Good afternoon, ladies and gentlemen. You're all welcome to Merck's webinar under the name of the Cash-Based Principles in Capital Budgeting Decisions. In this webinar, we brought down the cash-based principles to 5. And now, throughout the webinar, I will explore with you those 5 cash-based principles. First, my name is Maroun Zghaib. If you can hear me clearly, please type something in the square down to the left. Just type hi or okay in the chat window. Okay, hi Charles. Dareen, Raed, okay, so I think that the attendees are hearing me. As a way of introduction, my name is Maroun Zghaib. I'll be your host over the next 30 minutes or so to discuss the topic and answer your questions by the end of the session. So basically, if you have any questions regarding this webinar, please type your questions in the box down left. And at the end of the webinar, I'll be glad to answer all of your questions. So I have a bachelor's degree in finance from the Lebanese University, and I'm a US certified public accountant with a valid license. I hold a diploma in international financial reporting standards from the ACCA. I'm a candidate of third and final level of CFA chartered financial analyst. So basically, this is the history of my education. Professionally, I'm currently a management consultant with Merck Training and Consulting, specialized in finance, obviously. Before joining Merck, I worked as an auditor with Deloitte, and I left at the position of supervisor. I held several assignments in the Middle East and in Europe. Before joining Deloitte as an auditor, I worked as a tax consultant with PricewaterhouseCoopers, where I held several compliance and structuring assignments with PwC in the Middle East region. This webinar, in fact, is part of a module in the Corporate Finance Workshop. So the couple of slides that you will check right now, they represent a module or part of a module of the Corporate Finance Workshop, which will be conducted by Merck Training and Consulting in Dubai from the 3rd till the 7th of April of year 2016, or from the 13th till the 17th of November of year 2016. So basically, this 5 cash-based principles in capital budgeting decisions is like a 30 minutes or snapshot of the fully fledged, full cream program of Corporate Finance Workshop, which will be conducted and facilitated by myself in Dubai from the 3rd to the 7th of April and from the 13th till the 17th of November. To get started, I would like to define the topic or the word of capital budgeting and when the capital budgeting decisions are used. When I say the word capital budgeting, I can see a couple of names here like Charles, Dareen, Grace, Raed, Khalid, all the people that I can see over there. When I say capital budgeting, the word capital budgeting, does it rhyme something? Does it mean something to you? Okay, so basically I have no answers for now. Dareen is typing something. Money, maybe. So basically, when you hear the word finance, you relate it directly to money. But basically, capital budgeting is involved more on where to invest your money. I'm sure that each and every one of us and all the companies around the world have some sum of money that would like to invest. And when they are deciding where to invest their money, they need to look at the most profitable or lucrative investment. The capital budgeting exercise must be involved every time that the company has significant cash outflows and when there are certain point in future where the company will generate inflows. So basically, every time when the company is identifying and evaluating long-term projects, they have to apply the capital budgeting exercise. As an example, for a project where you have a major cash outflow today, which will result in potential cash inflows in the future, is introducing a new product or adding a new machine to the production facility. So every time you are introducing a new product or adding a new machine to the production facility, you will have to make major cash outflow today. But we all know that the sales of this new product will not occur at this year. The use of the production facility or the machine in the production facility will not occur all this year. the cash outflow to acquire the new product, the cash outflow to acquire the new machine, the cash outflow to set up the operations and the base for this investment will occur today, but the cash inflows will occur in the future. Another example where you have major cash outflows which will result in reduction of cash outflows in the future. So capital budgeting is not only used whenever you have a cash outflow today versus cash inflows in the future. Capital budgeting is used as well whenever you have a cash outflow today, but you have a reduction of cash outflows in the future. An example. Let's assume that your company decided to exchange its old software, accounting software, to a new software. Definitely the exchange or the outflow today will be massive. It will be huge. Employing the SAP, employing the JD AdWords, employing the Oracle, it will definitely cost your company around 2 million to 5 million. But when will the benefits from employing the new software come? The benefits from employing the new software will come in the future. How? By reduction in the payroll costs. So basically, this is another way where the company must employ the capital budgeting decision making. Is it worth making this investment today against the inflows that you will receive in the future? So basically, every time we have a major outflow that will be faced by either increased inflows in the future or reduction of outflows in the future, capital budgeting exercise must be employed. Now, the cornerstone to start is to identify what are the projects. First, you need to identify what are the project alternatives. You have this money. Where do I put my money? Should I put my money to replace a project to maintain the business? Should I put my money to replace a project for cost reduction? Should I put my money to expand on projects, to introduce a new product in a new market? So basically, step one is to identify what project alternatives I have. The second step in this exercise is to identify the cash flows. And I think that this is a critical step in the capital budgeting decision. Let's assume that you identified the best project alternatives, but your cash flows were not properly projected. What if you identified the proper project alternatives, but your cash flows missed a core principle in projecting the cash flows? Throughout this webinar, I will guide you on the 5 principles of using cash flows for capital budgeting. As you can see in front of you, obviously the 5 principles are decisions are based on cash flows, not accounting income. The second one is that cash flows are based on opportunity costs. The timing of cash flows is important. Cash flows are analyzed on after-tax basis, and financing costs are reflected in the project's required rate of return. From what I'm saying right now, I think that some of those concepts might be alien for you. You might be hearing those, it might be Chinese, it might not be clear, but I promise to guide you step by step on those 5 principles. Let us start with the first principle first, which requires that decisions are based on cash flows, not accounting income. When finance professionals are preparing financial statements, they do prepare the financial statements based on the accrual basis, which means that the revenues and expenses are recorded when the transactions occur rather than when the cash flows occur. In capital budgeting, you have to place the financial reporting aside. In capital budgeting, you have to place the accounting income aside. In capital budgeting, you have to focus on cash flows. And when we say cash flows, we are looking at the incremental cash flows. What do I mean by incremental cash flows? What I mean by incremental cash flows is that by introducing a new machine, definitely you might have other machines that are producing items. Definitely you might have other machines that are incurring costs. But your concern is only this machine. Only this machine that I introduced into the production cycle. How much revenue will be produced from introducing this new machine? And what are the costs that are directly associated with introducing this new machine? So basically, the change in cash flows that will occur if the project is undertaken. If I have other cash flows, other cash inflows or outflows that the company is facing for other products, other locations, using other machines, you have to ignore all other costs. Examples of relevant cash flows in terms of introducing a new product or introducing a new market or exchanging an old software would be: 1, the initial investment required for the new project. If I'm buying a new software, I will have to pay a massive amount to one of the software engineering companies. If I'm buying a new equipment, I will have to pay for the cost of this new equipment along with its installation, its inspection, and maybe its training. If I'm introducing a new product, you might probably have to design the new product, have the branding of the new product, introduce the new product. So basically, all those are initial investments requirement. When I introduce this new product, I will have some sales proceeds that will result from this new product. So basically, those incremental sales that are generated from this product have to be part of your capital budget. Additional revenues which are generated due to introducing this new product or market, due to this new investment. Additional operating costs. So when I say additional operating costs, it means we should ignore any previous operating costs. We should ignore any previous costs that are already incurred, disregarding if the company is introducing this new investment or not. Taxes paid due to this project and any taxes saved. Now, each and every one of those relevant cash flows will be explained. Starting with the concept of sunk costs. What are sunk costs? When I say the term sunk, it means irrelevant. As you can see, the money is drowning. As you can see, this is the money that I pay, but I will incur it disregarding if I take the project or not. So supposedly you decided to introduce project A. On the other hand, you will pay a service fee for a feasibility study in order to identify project alternatives. You will be paying the service fees disregarding if you took project A or project B or project C, or even if you did not undertake any project, you will pay the service fees. So basically, for such type of projects, service fees are irrelevant. They are sunk. So basically, when we say sunk costs, those costs are the costs that cannot be avoided even if the project is not undertaken. You might do a market survey to see if the product will be sold in the market or not, to see if the market desires the product or not. Let's assume that after the market survey, the product turned out to be non-profitable. You decided not to undertake the project. Even if you decided not to undertake the project, you already incurred those costs. So basically, those costs that you incurred for the market survey, those costs that you incurred as a service fee for the company who performed the market survey have already been incurred. Disregarding if you will take the project or not, they were incurred. Accordingly, they are not part of the project cash outflows. So the question is, if I incurred a consulting fee for a marketing research company to perform a market survey, if I performed, for example, a feasibility study, and I incurred some sort of fees in order to perform this feasibility study, is this part of your project outflows? Please type yes or no on the chat window so that I make sure that we are all on the same page. No, that's right. So basically, Khalid, you're right. Dareen, you're right. Thank you for participation. Charles, it's totally right. You're my man. Grace, no, that's right. So basically, any costs that are incurred, disregarding if the project is undertaken or not, are excluded. Those costs, we call them sunk costs. The second item that we need to focus about is the effect of externalities. When Coca-Cola introduced their new Coca-Cola Zero, definitely they had a major outflow. They had a major outflow in order to design the can, to test, to do market research, to do surveys, to test the can if it will be acceptable in the market or not, and to advertise it. When Coca-Cola Zero was introduced, some of the sales of the regular Coca-Cola Classic and the Diet Coke actually decreased. So what was the effect of introducing Coca-Cola Zero on the other Diet Cokes, on the other classic Coca-Cola? What happened is when Coca-Cola introduced Coca-Cola Zero, part of the sales of other competing products of Coca-Cola decreased. So basically, with introducing a new item, with introducing a new project, sometimes the sales of other components of the entity would decrease. For example, introducing a new model car, introducing the electrical car by BMW instead of their regular diesel or fuel cars. By introducing the electrical cars, we can anticipate, we can project that part of the sales of other cars of BMW that are based on fuel or diesel will decrease. Do you think this must be part of our analysis? The answer is yes. When you introduce a new product and this product is supposedly to take part of the sales of other products, this is part of the cash outflows in your analysis. So when BMW are designing their new car, when they are designing their new hybrid or their new full electronic car, BMW must take in the projected cash flows that part of the sales of their regular BMW cars will decrease. Why? The new electrical cars will take part or share of the sales of the regular cars. So basically, negative externalities are called cannibalization. Cannibalization is when the new product or project takes sales for an existing product. Loss in sales of the existing product is considered an outflow. I know, no money is getting out of your pocket, but it is taking part of the sales of existing products. Example, as I mentioned, a diet version of soft drinks. Sometimes a new product is introduced and it suddenly boosts the sale of an existing product. If the new product plays a role, or takes part in increasing the sales of any existing products, then you should take the sales, the additional sales that are incurred by the existing product, and add them as a cash inflow for the new introduced product. So to sum up the effect of externalities, if the new introduced product or investment will decrease or will lead to a decline in the sales of an existing product, this is a cash outflow of the new investment. And if the introduction of a new product would lead to boosting the sales of an existing product, the increase in sales of the existing product do not pertain to the existing product, they do pertain to the new product. Third, let's look at the initial investment outlay, after-tax operating cash flows, and terminal year cash flows. When we look at the initial investment outlay, usually most of the people, they try or tend to focus on the cost of the asset or cost of the equipment or the direct costs that they can observe. Basically, those are the costs that are included in the cost of the asset, shipping, installation. But I think that some people tend to ignore the investment in net working capital. What do I mean by investment in net working capital? Every time the company is introducing a new product, every time the company is exploring a new market, you should expect that part of the cash, part of the accounts receivable, and part of the inventory will be locked specifically for this new expansion. Since the company is locking part of its cash, part of its inventory, and part of its receivable for this project, this is an indirect cash outflow. Why? Because if you had this cash free, if you had those accounts receivable free, if you had this inventory free, the company could have used this money in the next best alternative by investing them and generating cash, generating investment income. So every time you are assessing the initial investment outlay, an entity must add over and above the fixed capital investment. It means over and above the cost of the asset, its shipping, its installation. They must assess the amount of cash, accounts receivable, and inventory that will be locked for this project. We say that the money is locked in cash, accounts receivable, and inventory. You ask yourself, what is the opportunity cost of this money? If I did not lock this money into cash, accounts receivable, and inventory, where would the entity use this money? Definitely the entity would use this money in the next best investment, and it will generally generate investment income. Now, looking at the after-tax operating cash flow over the project's life, I would stress on the word after tax. Yes, in some countries around the region, we have no taxes. But sometimes your investments can extend outside the boundaries of GCC. Plus, in the near future, and I hope not, definitely, some taxes might be imposed on companies operating in GCC. So basically, it's worth noting that in case taxes got imposed, taxes will play a critical part in deciding on your cash flows. When I say the after-tax operating cash flows, those are the incremental cash flows. When I say incremental, it means those are the additional sales from the new project or investment. When I say incremental cash flows, those are the incremental operating cash outflows related to the project. When I say cash flows, it means those are the inflows or outflows that are based on cash and not based on the accrual basis. I know that I have a lot of accountants in this chat windows, but Khalid, I saw your question and I will get back to you on this. Definitely you can take a picture and I'll get back to you on this later on. So basically, when we are looking at the cash flows, we mean the cash inflow from sales, the cash outflow from depreciation, and the cash outflow from operations. When I look at depreciation, technically depreciation usually from financial perspective and from accounting perspective, depreciation must result in an expense. Yes, you are totally right. But in capital budgeting, depreciation serves as a blessing rather than serving as a curse. In capital budgeting, depreciation serves as a reduction of taxes paid. Why? Because depreciation is deductible for tax purposes. So by introducing the new equipment, by introducing the new project, this is a long-term project. That's the first thing that we started with. Capital budgeting is about long-term projects. So by introducing this new project or this new investment, the cost of the project or investment will be depreciated over the life of the project or investment. Accordingly, every year the company will incur depreciation. How would this depreciation help the company? To see, depreciation is a non-cash operating expense, but it reduces the amount of taxes paid by the firm. Accordingly, the amount of depreciation that you actually recognized in the financial statements will serve as a reduction of taxes. Accordingly, the formula of the net cash flows will be sales, which are the cash sales incrementally generated due to undertaking the project. C is the cost. Those are the cash operating costs incrementally generated due to undertaking the project, minus depreciation, which are an outflow. I multiply by 1 minus tax in order to project the after-tax cash flow. So basically, T is the tax rate. If your tax rate is 30%, accordingly, from every $10 you are generating on the project, the amount of money that will go to the pocket of the investors, to the pocket of your shareholders, will be $7 because taxes will be paid. And then we add back depreciation. Why? Because this depreciation serves as a tax reduction. Those are the taxes saved from depreciation, not the depreciation per se. And another way, as you can see, the third box down, I mentioned that another method is, this is the box here. Okay, as I said, another method is to add back the tax savings caused by depreciation. So you can ignore depreciation from the first part of the formula. So you can have sales minus cost. Those are the cash sales minus the cash costs that are incrementally generated from the project, times 1 minus taxes. It means I am removing the tax effect, which I will pay to the government, plus the taxes times depreciation. T times D are the cash outflows that have been saved because you were engaged in a long-term project that has cash outflows related to a fixed asset. Yasmin is asking, how will the formula be if NUAE has no taxes? Shall I place it with 0? Yasmin, if there are no taxes, the D will be 0. Accordingly, no effect from depreciation. In the UAE, in GCC, depreciation is an expense like any other country around the world. But in UAE and GCC, there are no taxes. Since there are no taxes, you can simply eliminate, forget the effect of depreciation because depreciation will have no effect. Plus, the 1 minus T has no effect as well. Why? Because we do not have taxes. So when you are looking at the cash flows, the formula will be simply S minus C. It is the incremental sales from the project minus the incremental cash outflows. So your net cash flows from the project will be equal incremental cash sales from the project minus incremental operating cash flows. I did print this, I did type this in the chat window. Net cash flows is equal to the incremental cash sales minus incremental operating cash flows. You ignore the effect of taxes and you ignore the effect of depreciation. Yasmin, was I able to answer your question? Amazing. Let's proceed. The terminal year cash flow. Now, after looking at the initial cash outflow, where I pinpointed that you should take into consideration the effect of working capital invested, this is the locked money, this is the locked account receivable, this is the locked inventory that you need to incur every time you have a new project. After we highlighted the effect of taxes and depreciation of your operating cash flows, now it's time to look at the terminal year cash flow. In the terminal year cash flows, make sure that in case you have an asset that is worth something, you will have to sell it. Do not forget to take into consideration the salvage value. This is the scrap value. This is the value that you will generate on selling the asset at the project's terminal life. And in case you operate in a country where there are taxes, remember that you will have capital gain taxes. And those capital gain taxes is the portion that the government take due to generating profits on selling a certain asset. Over and above, you will have a return of the net working capital. Didn't we mention from the initial cash inflows and initial cash outflows, we said that initially the company will have to commit part of its working capital. At the end of the project life, the company will release this working capital. You would tell me, fine, why shall we deduct this working capital at the beginning of the project and then add them back at the end of the project? The net effect will be zero, right? I can totally agree with this question, but the answer is coming in the next slides. The answer is that whenever you are applying a capital budgeting decision, the timing of cash flows is crucial. If I give you $100 today or $100 in 3 years, you would definitely prefer the $100 today. Not because it is more secure to have $100 today in your pocket. No, no, no. It's because you will take the $100 today and you will invest it in the next best alternative investment. Go put it in National Bank of Abu Dhabi. Go put it with Goldman Sachs. They will invest it for you in the financial markets. Yeah, $100. Dream about it. But you will get some returns on this investment, right? So basically, the timing of cash flows is important. That's why at the beginning of the project, you will have to deduct the working capital investment. And at the end of the project, you will have to add back this working capital investment. But guess what? It will have a lower value than the initial working capital investment that you invested. Now, we have to look at the cash flows are based on opportunity costs. Here, I will summarize it in a way, or in a question, or in an example. Assuming that you are building a new factory on a land that you already own. So basically, the price of the land, you did not pay for it. The cost of the land has been paid by your grandfather. Over there, he used to have maybe some cows, maybe a herd. And then your dad came and he told you, listen, son, this piece of land is for you. Please maintain the heritage of the family. Don't do anything crazy about it. And then you decided that you would like to be a successful businessman. Why don't I build a factory on this land? So basically, you decided to build a factory on this land. You decided to have a big project on this land, but you did not take into consideration that the land where you are building this factory has a cost. You said, it's fine. It's my grandfather who paid for this land. It's for free. I should not take it into consideration in the project cash flows. Guess what? You're wrong. Why? Because cash flows are based on the opportunity cost. If you had to take this project from scratch, you had to buy this land. And when you are building the plant, this cost of land should be included in the cost of your cash outflows. So basically, anything that you own already that you did not pay for, in case you are using it in the project, it will be included as part of the project outflows. It is part of your project costs. Okay? So this is the second concept. Cash flows are based on opportunity costs, which means anything that you already own and you are using it for the project, it is considered as part of the project cash outflows. Why? Because instead of using this thing, instead of using this asset in the project, you could have used it in the next best alternative and maybe generated cash flows in the next best alternative. Third, the timing of cash flows is important. We do not look at cash flows from a nominal perspective. We look at cash flows from present value perspective. Accordingly, cash flows that are collected earlier in the life of the project are more important than the cash flows that you collect later in the life of the project. This is applicable. So Khalid is asking, does it, okay, I'll have to go back to Charles' question. Does it mean the benefits you could have received by taking an alternative action? Okay. Charles, I'll take you back to this slide. To cash flows are based on opportunity cost, and I would like to thank you for this question. What I mean in this, it's not the benefits that you could have received. I mean that if you are using the land for project A, even if you got this land for free, even if you did not pay the cost of this land, still you will have to assess the cost of this land and include it as part of your cash flows. Why? Because alternatively, instead of taking project A, the company could have used the same land in order to undertake project B. So in the previous example that I gave you, your dad gave you a piece of land and he told you, please son, use this land wisely. You thought that using this land wisely would be by constructing a new factory, a new premises for your operations. So basically, you choose option A. You chose option A for using this piece of land. Alternatively, you could have used the same piece of land and you could have raised a herd of buffaloes. Maybe the herd of buffaloes could generate cash flows as well, right? So basically, since you picked option A over option B, this means that this land could have been used in another alternatives and could have alternatively generated for you cash flows. Since this land could have generated for you cash flows, then the cost of the land must be included in your projected outflows. Khalid, you are asking, this is applicable to what is financed also. I think if I got you wrong, Khalid, I'll be able to answer your question in the next couple of slides, which deals with the financing costs. So if you can just give me 3 more minutes and I will reach the financing cost issue, okay? All right, amazing. So the timing of cash flows is important. Having or collecting or generating cash inflows from the project of $100,000 today is not the same as generating cash inflows of $100,000 in a couple of years. So it matters when and where the inflows are generated and the outflows are incurred. Point number 4, cash flows are analyzed on after-tax basis. So basically in GCC, I go back to Yasmin's question, in GCC we have no taxes. Since you have no taxes, you can simply ignore the taxes. But with the introduction of taxes, you will have to take into consideration how much the government, how much the regulatory authorities, the tax authorities will take a bite of your cash flows. So basically, we need to take this into consideration. You cannot continue walking blindly regarding taxes. Even if you are making projects nowadays, I think if you operate in the GCC, it might be a wise idea to have 2 different models. One model which ignores the taxes, considering that the GCC does not introduce taxes, and a second model which incorporates taxes, because guess what? There is a 50-50 chance that taxes will be applicable in GCC in the near future. Okay, so basically for all companies operating in the GCC nowadays, I do advise you to generate 2 models. One model that takes into consideration taxes. You have to be conservative. In financial accounting and reporting and finance, conservatism is a base. You have to be conservative. So basically, if you are preparing a certain model in order to project cash flows, please prepare another model which takes into consideration any taxes to be paid in case your company was subject to taxes. Okay, so basically it's obvious cash flows are analyzed on after-tax basis. And the last point is regarding financing costs. Okay, fine. I mentioned the initial cash outflows. I mentioned the working capital investment, the money locked in cash, account receivable, and inventory. This could be considered as an outflow. I mentioned the incremental cash inflow from sales. I mentioned the incremental cash outflows from operating expenses. I mentioned the effect of depreciation, how depreciation can save part of your taxes paid. I mentioned the effect of tax. I mentioned the salvage value at the end of the project, and I mentioned the return of working capital, but I never mentioned finance costs. The question is why? Every time you are engaged in a new project, definitely you need some sort of financing. If I'm buying a car, I will not pay 100% from my own money. If I'm buying a home, I will not pay 100% from my own money. What about investing in a big project that would cost the company $10 million? Do you think that the company would have cash of $10 million to invest their money instantly? No. The companies will invest part of this investment using their own money, which we call it equity investment. And part of the investment will come from bank financing, which is third parties financing. Okay. Since we agree that part of the financing will come from the banks, accordingly, the company will pay interest expenses. Why do you think I ignored interest expenses? To tell you something? I cannot tell you this because this is a different ball game. This is a different ball game because interest expense are incorporated within the concept or within something called the weighted average cost of capital. The weighted average cost of capital, which I just wrote down. Every time the company is investing in a new project, the company needs capital. This capital will come either from shareholders or will come from the bankers. The bankers will charge you interest and your shareholders will charge you a return on their investment. Accordingly, the cost of debt, which is the cost paid to banks, and the cost which is paid to the shareholders are calculated on an average basis under something called the weighted average cost of capital. So the weighted average cost of capital is the average cost of interest and the average cost that you pay to your shareholders. So after all, the cost of interest is incorporated into the project cash flows, but indirectly. When and how? When you discount the cash flows. This webinar is not about making the computation of net present value. This webinar is not about making the decision. This webinar is about the 5 cash-based principles and capital budgeting decisions. This webinar lets you know that you ignore the interest charges paid. But if you would like to calculate the weighted average cost of capital, if you would like to know how this weighted average cost of capital or discount rate changes from one project to another, if you would like to know how correct net present value is calculated, how payback periods are calculated, how the internal rate of return are calculated, and how decisions are taken, you will just have to subscribe to our MERX training in April or in November under the name of Corporate Finance Workshop. And then I will take you through all the process from generating the cash flows to calculating the present value, to calculating the weighted average cost, and to making the decision. Khalid, you asked the question, however, cost or return to shareholders can be reserved and not paid sometime. Exactly. Thank you, Khalid, for this question. The thing that is paid to the shareholder is not the return. What you pay to the shareholders is dividends. Dividends is simply a distribution. Dividends are not the return to shareholders. Some of the biggest companies around the world, they make massive profits and massive returns to their shareholders. And guess what? They do not pay any dividends to their shareholders. Why? Because dividends unpaid to the shareholders is reinvested money in the business. As I said, new projects requires investment. So basically, if the company does not pay dividends, it means the company is telling to their investors, to their shareholders, we are keeping your money in safe hands to invest them in a certain project. So basically, the return to shareholders is not what you pay to the shareholders. The return to your shareholders is the actual return on their investment, or what we call as return on equity. Okay? Khalid, did I answer your question regarding the cost or return to shareholders? Maybe? Yes? No? Okay. Thank you. So now I will demonstrate the cash flows. As you can see, at period 0, the company projected fixed capital outflow of $200,000. This is supposedly the cost of assets, installation, construction, inspection, up to the point where the capital asset is available to be used by the manner intended by management. The net working capital investment is an outflow. This represents the cash, account receivable, and inventory that has been locked specifically for the project. All those are usually incurred at point 0. Starting the first year, the company starts generating sales from the new project. The company starts incurring cash operating expenses, and there is depreciation. Yes, depreciation is a non-cash expense, but we include it here in order to show the effect. As you can see, depreciation is added back down. So up, we deducted depreciation. We apply the taxes, and then we add back depreciation. Accordingly, we can ignore the minus 35, and we can simply add back the taxes saved on depreciation, because depreciation is a tax deductible expense. Remember, if you operate currently in GCC, you might not need to do this. Why? Because there are no taxes. Yet, as I advised a couple of minutes ago, I do advise companies to start preparing from now on capital budgeting exercises based on 2 models. The first model will incorporate taxes. The second model does not incorporate taxes. You do not know what will happen. Please be conservative. So we have operating income before taxes. We apply taxes at 40%. This is the assumed tax rate. I hope this will not be the tax rate in the GCC, because this will be cut from our bonuses and increase in payroll. Then we add back depreciation. As you saw, we deducted 35,000. We applied the tax rate, and we added back the full 35. So in summary, we are adding back simply the tax saving on depreciation. We get the after-tax operating cash flow of 92,000. At the last year, at the terminal year, we will sell the assets. The after-tax salvage value is the cash flow generated on the sales of the asset minus the capital gain taxes that we paid. So the $40,000 are the inflows from selling the asset as scrap or salvage, less any taxes paid to the government, to the regulatory authorities, and the release in the net working capital. As you can see, this $30,000 that was invested or committed here was actually released here. But the present value of this $30,000 is definitely less than the present value of this $30,000. The present value of this $30,000 is $30,000. The present value of this $30,000 will definitely be less. So basically, we sum up all the cash flows. After summing up all the cash flows, we calculate the net present value, and we calculate the internal rate of return. Unfortunately, one more time, in this webinar, we will not discuss the calculation of net present value. We will not discuss the calculation of internal rate of return. We will not discuss decision making. This is a 30-minute to 1-hour module. This is a 30-minute to 1-hour snapshot of the corporate finance workshop, which is expected to be conducted in Dubai in April 2016 or November 2016. If you are interested, please contact us at Merck. We will be ready to serve you 24/7 to answer your questions and to help you in registration in case you are interested. And now, I open the floor to any questions regarding this topic. Charles, are you facilitating it? Yes, I am facilitating it. Thank you for the question. So, are there any questions regarding this topic or any other topic? I now open the floor to any questions relating to the 5 cash flow principles in capital budgeting. Remember, this webinar is about the cash flows. This webinar is not about net present value calculation. This webinar is not about weighted average cost calculation. This webinar is not about decision making. If any questions pop up on your mind from now till the next couple of days, please do not hesitate to send me an email to amsgheb@merck.com. amsgheb@merck.com is my email. You can drop any question in my inbox and I will be more than glad to contact you. I'll be more than glad to answer your question. If you have any questions that requires a phone call, just write down your phone number and I will call you back. You're all welcome. That's it for the webinar, the 5 cash-based principle in capital budgeting decisions. Stay tuned with Merck for any future webinars, any future topics. We will send you emails regarding any future webinars. Grace, regarding the slides, for you, we will send you the slides. Please drop us your email and we'll give you the slides. Okay, that's it. I enjoyed spending the last 45 minutes with you and hope to see you in future Merck webinars. Have a nice afternoon, have a nice weekend, and see you soon.
Merck.com